Hello, Grant. Welcome. I'm excited to have our podcast up and running again. This is exciting. I want to give value to our listeners because buying a home can be stressful, not on the moving part, but just everything that goes into purchasing a home and moving is super stressful. So I just
Mhm.
want to make it unstressful for folks and just giving them information, whether they're ready to buy today, tomorrow, or in a year from now. Just take nuggets from our conversation so that they can apply it to wherever they are in the process.
Yeah,
So, Grant Goad with Statewide Mortgage, and I'm Kristie Dimarakis with LPT Realty. How are you today?
I'm doing great. Thanks for doing this, Christy. I think it's extremely valuable, especially with so much information we have available to us on socials. As you know, we're both on social media, so we're trying to not just be another part of the noise out there, but really give insight, experience, the years we've had, both in myself in the mortgage industry, you in the real estate industry. I think it's important that we have a voice too out there, not just what's on the X feed or on Instagram or TikTok or whatever. So appreciate you doing this. It's going to be good for hopefully future listeners.
Yeah, absolutely. So most of us are not lottery winners, right? So
I'm
we've
not.
got, unfortunately, we don't have that lottery house.
Mhm.
But affordability is what we're going to talk
Yes.
about today. So
Yeah.
what does that look like? How can we help you, or how can your realtor or your lender help you with your home purchase? Whether if you're, just getting out of college and you're looking to purchase a home, or later in life and, it's been, 20 plus years since you've purchased a house, no matter where you are in the process, we would just want to give you kind of up-to-date information and talk about what the affordability looks like. Because everyone that I typically work with, they just look at the purchase price of the home and say, okay, a $400,000 home is what I can afford. But
Right.
what does that really, really look
Hmm.
like? Especially in the state of Florida, when we've got insurance things to think about, you've got CDDs. So let's pretend that you're just getting a phone call today
Hmm.
from a new buyer. What would that conversation look like or sound like if you've got somebody who either one hasn't purchased a home ever before in their life, or two in a really long time? How do you start that conversation with folks?
Yeah, so that is truly where we start. We start with, okay, what can you actually afford? Because it is a misconception. And honestly, it's a lot of times our lenders, our industry, it's our fault because a lot of times what we put on our pre-approval letter is what? We put a purchase price and we say you're pre-approved for 400,000. Well, you and I both know that that 400,000 really means they're pre-approved for, let's just use a payment of $3,000 as a generic payment. That's really what we're pre-approving them. It's the monthly payment. And so while pre-approval letter is great to know that, yes, you can go shopping for homes around that price range, it's really good to know. And that's what we work with as your lender. Um, Truly what goes into the monthly payment that you're going to be dishing out every single month, because that's really what we're pre-approving you on based on those numbers. So it's important to know what goes in those, right? So the first step is, okay, how much money do you have to put towards this transaction? Are you putting a down payment? Because that will affect the monthly payment. Obviously, your credit score will factor into the interest rate, which we can talk about here in a second. But knowing, starting off fully, like, okay, what is your current monthly payment situation, whether you're renting right now, whether you own a current home, or do you live rent free? Like, and that's a true question we're asking folks is, okay, how are you going to go from your current situation to next month paying this mortgage, right? We want to make sure not only for mortgage guidelines that it fits and we can qualify you, but we also want to be sure you and your lifestyle, is it going to fit? Can you survive on this monthly payment? Or if we get you into this house, even if we can qualify for you, will this monthly payment drown you, right? And we don't want that to happen because that's just going to add in to the snowball effect of of later financial issues if you're struggling right out of the gate to pay this mortgage payment. So yeah, we start at the basics with, okay, let's look at your comfort monthly payment and let's talk about that. And then from there, we talk about how much funds you have for closing, because that factors in. And then once we have your credit and full application, then we can actually put you in a specific loan program. So those that's kind of where we start with most folks once we get that application going.
Yeah, because way back when in like 2008, when they were just throwing loans everywhere to
Yeah.
anybody,
Hmm.
back in that period of time, that wasn't a very big conversation, is what
No.
you feel comfortable paying. It's
Right.
just you applied, you got the loan in a nutshell.
Sure.
But that's one of my first questions when I sit down with buyers for the first time is, what do you feel comfortable? Even
Yep.
not even necessarily what are you paying in rent right now, but what do you feel comfortable? Because
Sure.
unfortunately, we know like rent payments in Tampa are crazy high. So, what kind of payment do you feel comfortable with?
Yep.
Is because we know none of us want to be house poor, right? To
Sure.
have to work to pay that mortgage
Yeah.
payment.
Yeah.
Um, we want to be as financially free as we possibly can, right?
Absolutely. Yeah. You don't want to, like I said, you don't want to be drowning in your all of your, majority of your income is going into this mortgage payment. And that's part of why we have mortgage guidelines, right? It's to show that you have the ability to repay this loan that we're about to give to you. So, I do appreciate those guidelines are in place. That's why we ask for documents. That's why we check for your income. So it can really verify that you can truly repay this. Now, just because we can show that on paper and you check all the guidelines and you check the boxes is exactly what you just said. Like, it, are, is your financial life going to be negatively affected with this payment? We need to look at that as well, or get connected to a financial advisor that can talk you through that, right? That we can help you in that situation, make sure that you're in a good spot when you close on this house. So,
Yeah. So the very basic level is
mm,
what do our listeners, what do first-time home buyers need to kind of consider of what encompasses that monthly
the
mortgage
payment.
payment?
Right. Yeah. So that's the big thing. So the bulk of it is your principal and interest, right? Depending on the loan term that you're in, most folks right now are closing with a 30-year mortgage. That's the most popular. But you can also close in a 20, 10, or 20, 15, 25, any of those terms. That'll affect your principal and interest payment, and obviously the rate that we lock in. Um, Along with that, most folks don't realize that your property taxes and your homeowners insurance are also typically included in that mortgage payment. Now, you don't have to include those. You can exclude those from what we collect on a monthly basis, but we recommend collecting those for the most part in most situations. But those will affect the amount you can qualify for, but also be the amount that you're paying to the mortgage company after the loan closes. So property taxes, homeowners insurance, and there's another one, which is homeowners association dues that are not collected by the mortgage lender. Those will always be paid on your own directly to your HOA community. However, we will consider that when we qualify you for the mortgage. So you might get enticed by a very low purchase price on a specific type of property. However, they have $1,000 a month HOA dues. That's going to affect your, how much we can approve you for or pre-approve you for upfront. So those are the main things to consider: is the property taxes, which we can look up beforehand, right? Before you even go to look at a house. That is public information that we can access, that Kristie can access, that you can access to. Um, that we can look at those property taxes and see what it's going to look like once you close. Homeowners insurance, we can also get a good idea. We've got lots of contacts that can run quotes that can give you a good idea of what homeowners insurance premiums are going to look like. And then, of course, HOAs are already set. So really, you can kind of know your monthly payment really before you even go look at a house. And that's what we recommend, is when we are in the pre-approval stage, we've given you that pre-approval letter, you're shopping with Kristie, that we really have that property already structured and sent to you before you go look at it. So the client knows exactly what their monthly payment's going to be. So those are the main things that make it up.
And that's to me like the golden ticket, if you will, for
Hmm.
working with a lender that you like to work with. So you and I are working with a budget sensitive buyer right now. And we need to know, like, is this, even though this house is X amount of dollars, can this buyer afford the home
Hmm.
after insurance and all the things?
Yep.
And the closer we get to looking at homes that are close to their top end of their budget of X amount of dollars, let's just say it's 300,000,
Hmm.
we actually have to look for a home that's less than
It's less. Yeah.
300,000. Even though our pre-approval says 300, like you
Right.
said,
Yeah.
we've got to cut it back. And to me, that's so important because I never want a family to fall in love with a home and then find out that that home is
Right.
just out of their reach. You
Hmm.
know, that it's getting off from work, taking a weekend off to go look at
Yeah.
homes and getting so vested in interest into the home. And then, wow, we can't afford this.
Yeah.
It's
Major letdown. Yeah.
it's kind of like going through COVID again, where you're putting in 15 offers and you got
All
to
those
tell your
offers. Yeah.
buyer,
Yeah.
sorry, you can't
Yeah.
have this house.
Right.
So that's where that relationship
Hmm.
that you and I have, that
Hmm.
you and the buyer have, like all three of us, really
Yeah.
coming
We all work
together.
together. Hmm.
The
Yep.
one thing we didn't talk about in factoring that is the CDD.
Yeah, that's part of your tax bill. Yeah. So here in Florida, that is something to consider. I'm glad you brought that up because a lot of times the CDD fees won't show up on um, like your major search sites for real estate. Sometimes they will only put the base property taxes, but when you actually go look at that bill on the county website, you'll see at the bottom that CDD fee, which adds to your tax bill, and that's a huge thing in your newer build communities, which I know you do a lot of. So you'll see that a lot, especially on communities that haven't been around that many years. Those CDD fees will show up on there. But when I'm looking at numbers, I'm checking for that. So if you send me an address, I'm going to look at the county bill every single time. I don't trust, the big um, search sites and things like that on what it says the tax bill is. We're going to go to the county website directly, where that's Hillsborough, Pinellas, Pasco, whatever county in Florida. It's all public information. We can access it and know exactly, okay, there's the property taxes. Oh, and there's a $2,000 annual CDD that we have to include. And that will be included in your tax bill. So when we close you on the loan, we're going to factor that in onto the monthly escrow collection. So we will take that in consideration. But here in Florida, that's huge. I'm not sure about other states. I'm sure it's the same or labeled something different. But here in Florida, that's big. Yeah.
Yeah, so me being from the Chicago area, like that's not a thing,
Right.
They're
It may
older
not be. Yeah.
homes
Yeah.
and, you don't have these mass communities that have lagoons and
Yeah.
tennis and
Yeah.
pickleball. And it's like you have no reason to leave your neighborhood because everything's like right here.
Yeah. The
So if we
city.
have listeners, who are thinking about moving to Florida, to Tampa Bay, like that's
Hmm.
a thing to
It is.
consider. So, they can be $1,700 a year. They can be
Yeah.
$3,500 a year.
Yeah.
Each
I've seen a wide
community
range.
is
Yeah.
is different. So
Hmm.
it's definitely something to kind of put. I always tell my buyers, if you're driving around and you see a community that has a ton of amenities and it's a newer community, there's a CDD
Yeah.
attached
Just
to it.
assume.
Like
Yeah.
no questions
Yeah.
asked. And just so that our listeners know, that CDD is a bond that the builder takes out, and it's
Hmm.
typically for 30 years.
Yeah. It's a long time.
Is typical. So something to consider. So if the house is less than 30 years, ask your lender, ask your realtor, is this a CDD community?
Hmm.
To me, it's very easy. Like for instance, Pasco County. Just go to the Pasco County, punch in the address, and then scroll all the way to the bottom,
Hmm.
and It's unfortunately like magic. It just
Yeah,
shows up at the
yeah,
bottom.
yeah, absolutely. And it'll be on, the counties will collect these. So, like I said, they're going to be on your tax bill, but it is important to know that just because these, the big sites show my property taxes are 4,000, they might not show the actual CDD as well that shows up at the bottom of those tax bills. So
Yeah.
really, really good point.
Yeah. So CDD, Community
Yeah,
Development District is what it stands for, short
I like it.
CDD. So all of these factors
Yeah.
kind of affect or do affect your monthly mortgage payment.
Mhm.
And so let's kind of divert just a second.
Mhm.
We're talking about newer communities, and this is a thing right now because in our area we have so much new construction is I know for myself, when we bought our home here in San Antonio, it wasn't advantageous for us to use the builder's lender. We went off on our own. It was going to take like
Sure.
5 years to make those numbers work
Right.
because to some degree, there's just moving numbers on a piece of paper. But my point is
Mhm.
that I want our listeners to really truly understand is when you buy from a builder and it's a brand new home, sometimes your property tax bill at that moment can be like $100.
Oh, for
And
sure.
then
Yeah.
a year later, you get
Mhm.
your assessment because we pay taxes in the rear for
Mhm.
property taxes. So come this fall, you get your tax bill, and then suddenly, oh my goodness, it's now like $6,500.
Yeah. Yeah.
So, what is your advice for people buying new construction and just remembering to
Yeah.
just so that because
Sure.
it's gonna and how that affects the money in escrow that you're gonna have as well next
It
year.
does. Yeah, so anytime I'm working with someone who's buying new construction, we're always going to pull what's called a property tax estimator, which is also public information on the county websites that we just mentioned. So let's just take Pasco County, for instance. They've got a great one. So anytime I see a new construction property come through, the first thing we're going to do is check the property tax site. If it shows $300, that means that the builder has only been paying taxes on the actual dirt, right? So now that there's a structure, there's a home, the county's going to reassess this house next year and say, oh, there's a lot more value here that we can tax. And they're going to tax you, no doubt. Um, so you have the ability when you close on a new construction property to actually close with estimated property taxes. And we highly encourage that. Basically, you shouldn't have a choice in that. You really need to do that because you're going to pay this money anyway. So we will pull that property tax estimator. We'll confirm it with the title company. They'll pull theirs and we'll compare and make sure we're not over collecting and not under collecting for those taxes at closing. That way, you're prepared come November when the county asks for those taxes, you're going to have sufficient funds in your escrow account to pay those taxes. So pulling that property tax estimator is essential on new construction. We're working on a few clients right now where we're doing that. And the title company, we're closing with estimated property taxes. Now, if for whatever reason this never happens, but let's say the county decides not to collect as much as we estimated, if they don't, that's still your money. That money doesn't disappear. That money is held in an escrow account, your escrow account. And if there's too much money in there, you're going to get a check written to you by your current mortgage servicer, right? That's your money. You can say no. You can say keep it in there. Let's just in case homeowners insurance increases, we'll have another buffer. You can always choose that, but don't be scared that you're paying too much, right? We're going to make sure that any mortgage servicer is not going to hold on to extra funds if they don't need it for the following year. So definitely look at that. Um, Definitely consider that when buying new construction. That should be your number one thing. Whoever you're working with, whichever mortgage lender, it could be the builder's lender. Just make sure they're running those numbers for you because that could be a huge sticker shock come a year later when the taxes are due and your mortgage servicer is saying, hey, you owe us 5-6 grand because we had to pay your property tax bill. So now your mortgage payment's going to go up by, several $100s a month to repay us. So
Yeah, because
definitely consider that.
I've seen it go up as much as $400
Oh, for sure.
a month
Yeah.
with new construction. So
Hmm.
if you only take one thing away from our
Yeah.
conversation
Yeah.
today, that is the key because it goes
Yeah.
back to what we were originally talking about not being house poor. So
Absolutely.
that $400 extra a month
It's huge.
could be a huge breaking point, for you. I met with a couple yesterday who have only lived in their house a year and a half, and they brought new, and
Yep.
he's already wanting to sell a year and a half later because all of these factors kind of played
Hmm.
into it, and he feels like he's spending too much
Yeah.
money on a monthly, mortgage payment.
Yep.
Um, so last thing I want to talk
Hmm.
about before we end our conversation is it kind of goes along with what you already said, but that PMI.
Hmm.
We could spend a whole nother
Yeah.
conversation of 30 minutes talking about it, but just give just a quick overview of
Sure.
what people need to think about when, because that's PMI is if I had to put 10 people in a room, I'd probably say nine of them don't know what
Yeah.
PMI is.
Yeah, it gets lumped in with your homeowner's insurance. And like I said, I kind of brushed over it earlier. So again, I'm glad you brought it up. But PMI stands for private mortgage insurance. That's on your government-backed loans that we do. For your conventional loans, you'll have what's just called MI, which is just mortgage insurance, right? They all mean the same thing. It's basically insurance that the lender requires to protect their investment, basically. So, in case of a default, in case that loan never gets repaid, the lender will get repaid by whoever's backing this loan. So, it's definitely a factor to consider, and it changes based on what type of loan program that we're in or that you qualify for. So, if you're in an FHA loan, which is very popular for a lot of first-time home buyers, it allows a little bit lower credit score. That's a fixed expense that you will have for the life of the loan, that will never go away. With a conventional loan, if you put less than 20% down, that's the standard rule. Now, there's some exceptions. There's some ways around that, which we can spend a whole other episode on. But in general, if you put less than 20% down on a house, you will have mortgage insurance even on a conventional loan. So obviously, it's less the more you put down. So if you were to put the minimum down like 3 to 5%, your MI is going to be a little bit higher. If you put 10 plus, it's going to be a little bit reduced. So it's required when you close on it if you put less than 20% down, and it will automatically fall off of your loan on a conventional loan once you reach 78% loan to value. I know that's random, but once you've reached that value, that loan to value, once your loan balance is down to 78%, it will automatically go away. You can actually request it if you want to revalue your house. Let's say you think home values have gone up over the last couple of years since you originally closed. You still have this mortgage insurance that you're paying on a monthly basis. You can call your servicer and say, hey, home values have gone way up. Can we reassess and see, am I already at this 80% loan to value? And they can actually remove it from your loan if they also, view your house as being more valuable. So there's two ways around that. You can actually front load it where you pay for the whole insurance premium up front and you don't have it monthly, or you can you choose to pay it monthly on those conventional loans. So there's lots of things to play with, and it really depends on number one, credit score, what loan program, and how much money down. So that is definitely something to consider inside that mortgage payment. But you can expect on a normal loan, $150 a month on the average loan right now that we're seeing is expecting in the mortgage insurance part of your monthly payment.
Yeah, so people that are listening right now, that goes back into what we're talking about today, the affordability piece.
Mhm.
So all of these factors that we've talked about today factor into what that monthly mortgage payment is going to look like. So
And it sounds like a lot until you see it on paper. And that's why I like sending estimates on every client is so like, okay, it's hard to visualize all these numbers when we're talking about it. But when you see it broken down on a monthly payment, you can really kind of see, okay, now I understand the total that's going into this. So that's why I always recommend before you go and look at a house, get your pre-approval letter updated to whatever you're going to offer and have that estimate before you even go look at the house to really see all the numbers. So,
Yeah. Yeah,
mhm.
absolutely.
Okay.
Well, there's affordability in a nutshell,
Yeah, we answered
right?
everything, right? All right, we're
Yeah,
good now.
yeah.
Just,
Yeah, absolutely. And I think it's just a great topic for first-time home buyers, like I
yeah.
said.
Hmm.
Maybe you're a couple about to get married and start a family, and you want to have maybe that house isn't doable right now, but maybe later this year. These are some things you can really start, really pulling together and really thinking about. So I
Hmm.
appreciate you, Grant. Grant Goad
Thanks,
with
Kristie. Appreciate you.
Statewide Mortgage.
Statewide mortgage. Yeah, good job.
Statewide Mortgage. And in the comments below, we'll have your contact information. People
Okay,
want to
great.
reach out to you to ask you more questions. His loan process is super easy. It's literally a
Yep.
click of the button, fill out the application, and he can get you
Let's
rocking
talk.
and rolling with a
Yep.
pre-approval letter. And so, yeah, I thank you so much. And like I said, comments below, and we'd love to hear your thoughts. Did you know about the PMI? Did you know about a CDD? Love to hear your thoughts in the comments below.
Thanks, Kristie.
Thanks.